Look at these two commutes. On the left, a young professional is gripping the steering wheel of a leased luxury SUV, stuck in gridlock, stressing about an upcoming meeting. On the right, someone roughly the same age is reading a book on the train, completely unbothered. That difference in stress rarely comes down to the actual jobs they do. Usually, it traces back to a specific moment a few years earlier, the day they received their first real professional paycheck. For the first time in your life, you suddenly have a significant influx of unallocated discretionary income. Immediately, that cash forces a trade-off. You have to choose between purchasing visible items that signal your new status to your peers, or quietly acquiring financial assets that no one else can see. This flowchart breaks down exactly how that fork in the road operates. From the first paycheck node at the top, you can branch left into the red path, the status game, where income converts to luxury vehicles and premium apartments. Or you can branch right into the green path, the wealth game, where income converts to unglamorous transportation and a growing investment portfolio. This choice sets the starting line for your financial trajectory. It determines whether your salary remains a tool for your survival or becomes a tool for your ownership. From a young age, society conditions us to believe that wealth is highly visible. We are taught to measure success by the Rolex on the wrist, the oversized mortgage on a McMansion, or the first-class flight posted on social media. Because of that conditioning, we naturally assume the person driving the $50,000 truck is financially secure, while the person in the 10-year-old sedan is struggling. This bar chart reveals the mathematical reality behind that assumption. That large, visible assets column is almost entirely supported by consumer debt, while the underlying green liquid assets column is practically non-existent. Highly visible wealth usually correlates directly with low actual net worth. True wealth is exactly the opposite of what society displays. It is the money you do not spend. We call this ghost wealth. It is the intentional, highly calculated gap you engineer between your ego and your actual income. Entering this game requires a massive psychological shift. You have to entirely abandon the goal of looking rich to your peers and instead focus entirely on the mechanical, invisible process of actually being rich. Focusing on social status hides the mechanical reality of how financial independence is actually built. Let's look at the standard move in the status game. You land a decent job at 22 and immediately finance a $50,000 vehicle to match what your coworkers are driving. There is a genuine short-term psychological reward here. You get the nods of approval from your friends, you feel successful, and you feel like you belong. Let's look at this comparison matrix to see the true financial impact of that validation. We will start with a baseline take-home pay of $5,000 a month for the status player in the left column. By inflating lifestyle to match that salary, living expenses jump to $4,000, and that new truck is a massive part of the drain. Between the loan payment, premium insurance, fuel, and heavy depreciation, it quietly pulls $1,400 out of the budget every single month. After taxes and basic living costs, that heavy vehicle obligation entirely consumes the potential investment gap. The monthly savings rate drops to zero, flatlining their ability to build wealth. The status game requires a brutal trade. You are trading decades of your future autonomy for a social asset that is losing value every time you drive it. To enter the wealth game, you have to pass through a mandatory psychological barrier. I call it the ego death. Ego death requires very specific, unglamorous material inputs. It means bypassing the dealership entirely to buy a reliable used car in cash. It means splitting an average apartment with roommates for a few extra years instead of upgrading to a luxury high-rise. There is heavy friction here. Your peers will likely think you are broke. Navigating the social discomfort of appearing perfectly average while holding a good job is the hardest part of the strategy. But the mathematical output of that discomfort is incredible. Over in the right column, the ghost wealth player brings home the same $5,000. But by embracing lifestyle deflation, their expenses cap out at just $2,000. That creates a massive unallocated cash flow, $3,000 every single month, completely protected from banks, lenders, and auto dealerships. Embracing temporary social discomfort is the only viable mechanism a young professional has to manufacture this kind of early investment capital. Having $3,000 in surplus cash is only half the battle. If you let it sit in a checking account, inflation will slowly eat away its purchasing power, so you automate. The moment your paycheck hits, that $3,000 is automatically routed directly into a brokerage account, buying broad market index funds. Every dollar you invest becomes a silent soldier. By buying index funds, you are acquiring fractional ownership in the most profitable companies on earth. While you are sleeping or driving your used car, those soldiers are working to capture dividends and compound your capital. This line graph tracks the historical baseline of what happens next. If we apply the market's long-term average return of roughly 8% a year to those $3,000 monthly contributions, the exponential growth curve begins. Projecting that math forward just 8 years, your portfolio grows to approximately $400,000 by the time you turn 30. Now we plot your living requirements. Because you kept your ghost wealth lifestyle lean, your annual expenses are roughly $24,000, maybe $32,000 with a few upgrades. That gives us this flat expense line. At 8%, a $400,000 portfolio organically generates roughly $32,000 a year in passive growth. The moment your investment yield breaks through your living expenses, you hit the crossover point. There is a behavioral constraint to acknowledge here. This capital remains locked in the stock market. You cannot withdraw the principal, and you must maintain strict emotional discipline during periods of high market volatility. By fiercely protecting the investment gap, the mathematical threshold to stop trading time for money can be crossed in less than a decade. So, which wealth strategy actually aligns with your career goals and your personal risk tolerance? This chart maps the need for peer approval vertically and desire for financial leverage horizontally. The status player lands top left, achieving social validation but permanent wage dependency. The ghost wealth master sits bottom right, guaranteeing financial leverage by 30, but accepting high social friction. The ghost wealth path is not for everyone. If you genuinely tie your self-worth to outward displays of success, living below your means will feel miserable and ultimately toxic. Identifying how much social friction you can personally tolerate will dictate your ultimate timeline for freedom. If you cannot sustain total lifestyle deprivation, there is a middle ground. Let's add the balanced optimizer to the top right quadrant. This is a hybrid approach. You still avoid bad debt, but allow for moderate upgrades, like a nicer apartment or a slightly newer car, while automating a smaller portion of your income. The impact on your timeline is mathematical. Dropping your investment rate delays the crossover point significantly, usually pushing financial independence back to age 45 or 50. You experience far less social friction during your 20s, but you are actively choosing to accept 2 extra decades of mandatory employment to pay for it. It comes down to a single evaluation. Is driving a premium car today worth performing 20 extra years of required labor tomorrow? Protecting the gap between your income and lifestyle is the only way to permanently buy back your future from the labor market.